Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Hello and welcome back to the channel. Today, we're diving deep into fascinating stock that recently popped up on our hard-to-borrow screener, BYAH, or Park Biological Technology Company Limited. This company, operating in the consumer defensive sector, specifically household and personal products, has some truly eye-popping cost-to-borrow fees right now, and we're going to break down exactly what that means and why it could be significant for potential short squeeze. Let's start with a quick look at Park Biological Technology Company Limited. BYAH is an investment holding company focused on developing skincare products in the People's Republic of China. They operate through two segments, product sales and franchise service, offering a range of products from basic skin physical protection to exfoliation and sebum foam. With a tiny market cap of just $3 million, BYAH is a micro-cap stock. To chart BYAH's recent price action, its recent performance has been challenging. Today alone, BYAH is down 19.14%. Over the last 5 days, it's fallen 37.47%, and in the last 30 days, a significant 61.56%. Volume today sits at 795,500 shares, which is quite low compared to its 30-day average volume of 9,313,866 shares, giving it a relative volume of only 0.1. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why do we care? When you short a stock, you're betting its price will fall. To do this, you have to borrow shares from someone else, sell them, and then buy them back later at a low price to return to the lender. That's where CTB comes in. It's the annualized fee you pay to borrow those shares. A high cost to borrow, especially one exceeding 100% annually, is like paying extremely high interest on a loan. It tells us that there's either very high demand from short sellers to borrow the stock, or a very limited supply of shares available to be borrowed, or often both. Why this stock is hard to borrow right now. Now let's look at BYAH specifically. This is where it gets interesting. The current cost to borrow fee for Park Biological Technology Company Limited is a staggering 576.4% annualized. Highlight CTB number to put that in perspective, that's nearly 6 times the value of the stock every year, just to hold a short position. While the CTB momentum has dropped by 52 percentage points over the last 5 trading days, meaning the fee has come down from an even higher peak, 576.4% is still astronomically high. Shares available to borrow. Furthermore, there are only 20,000 shares currently available to borrow. When you consider BYAH has an estimated float of 2.0 million shares, 20,000 is an incredibly tiny fraction. This extreme scarcity, combined with the high fee, suggests strong short interest relative to the available supply. Our internal composite squeeze score for BYAH is 45.7 out of 100, indicating several underlying factors are aligning, but it's not an extreme score. It's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signal that short sellers have very high conviction in their bearish thesis and they're willing to pay a premium to maintain their short positions. Squeeze mechanics explain. So, how does a short squeeze actually work? Imagine this, a stock like BYAH has a lot of short sellers betting against it, driving up the CTB. If something causes the stock price to start rising, perhaps positive news, an influx of buying volume, or even just general market sentiment, those short sellers face a dilemma. Not only are they losing money on their short positions as the price goes up, but they are also bleeding cash daily due to that exorbitant 576.4% CTB fee. At some point, many short sellers will decide to cut their losses. To close a short position, they have to buy back shares in the open market. This forced buying pressure adds to the existing upward momentum, pushing the price even higher. This creates a feedback loop. Rising prices force more shorts to cover, which pushes prices higher still, snowballing into what we call a short squeeze. The limited supply of just 20,000 shares available to borrow for BYAH could exacerbate such a scenario if it were to unfold. Dilution risk check. A critical factor in any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, effectively increasing the total number of shares outstanding. This can completely negate a short squeeze thesis because it floods the market with new supply, making it easier for short sellers to cover their positions and often driving the stock price down. For BYAH, we've performed our diligence. No recent dilutive SEC filings such as -1, -3, or 424B have been found in the last 90 days. Show no dilution checkmark. This is a positive sign for any squeeze potential, as the existing float isn't being immediately expanded. Also, we found no recent reverse split for buy in our look-back window, which can sometimes precede dilutive events or reflect financial distress. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given BYAH's situation, the incredibly high 576.4% cost to borrow, the mere 20,000 shares available to borrow against the 2.0 million share float, and no immediate dilution risk, what should you be watching for? Key indicators would include any sudden spikes in buying volume, especially if it exceeds the current low relative volume. Show volume chart reversal in the recent downward price momentum would also be critical. Keep an eye on the cost to borrow itself. If it continues to climb or if the shares available to borrow completely dry up, it increases the pressure on short sellers. Also, any news specific to BYAH Biological Technology Company Limited, especially within its consumer defensive skincare sector, could be a catalyst. In summary, BYAH Biological Technology Company Limited presents an interesting case study with its exceptionally high cost to borrow and extremely limited shares available. While the recent price action has been significantly negative, these underlying conditions are what attract the attention of potential squeeze traders. Remember, high cost to borrow is a signal, not a guarantee. It's a testament to the power of understanding these nuanced market mechanics. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments below what other stocks you'd like us to cover. Thanks for watching, and we'll see you in the next video.